Hey everyone, this is Ben Morales, your personal financial coach, and today I'm going to be dealing with the topic of mortgage rates, right? And I want to explain to you why, if I had a mortgage right now, which I don't, I haven't had a mortgage in 3 years. I actually use home equity lines of credit. But if I had a mortgage, I would not be rushing right now to get a refinance. We know that in the market, what's happened is that the interest rates are starting to drop in the markets, and eventually somewhere down the line it's going to start to impact more the mortgage rates. And so what that means is people start to get FOMO, right? They start to get the fear of missing out. They don't want to miss out on that 1% lower. They don't want to miss out on that 1.25% lower. They want to go ahead and they want to start to refinance because they want to save a couple of $100s. So on paper, that might not seem like a bad idea, but I want to show you today the actual cost of what a decision like that may cost you, so that you could take a step back and look at it before you make that decision logically, and what's the true cost behind it, so that you avoid a mistake, right? Like a lot of people right now are probably getting ready to make. So I wanted to use an example of current interest rates right now. So in January of this year, 2025, interest rates were right around 7% for a 30-year mortgage. Now, let's say I don't, but let's say I had a loan at that time, and that loan was $350,000. Now, that loan, if I would have bought my home at that moment in January, where the interest rate was 7%, there's two components to a mortgage payment. The first component is the principal, how much is actually impacting the balance of the loan. And the second component is the interest. How much of your payment is going toward the interest? Well, because this is a loan and every mortgage is a loan, just like a school loan or a car loan, anything that is a closed-ended loan, that means that the interest costs that you're making to that loan on a daily or on a monthly basis, those interest costs are being paid up front. And so that's what I wanted to draw out today. So let's ask the question. At a loan at 350,000 at an interest rate of 7%, how much is the actual payment on that loan? Well, the payment for that loan is actually $2,328.56. Now, of that $2,328.56, I broke down how much is actually going to the principal and how much is actually going into the interest. And you can see it's disheartening, right? Because at that beginning of the loan, already right off the bat, 88% of that first payment that you made, that I would have made as well, goes toward paying down the interest. 88% of your cash flow is actually impacting or is happening to enrich the bank or the institution that gave you that loan, instead of chopping away at that balance, right? Only $286.89 is actually impacting the balance, which is only 12%. So you would think, okay, as the years start to move forward, I wonder how this is going to look for me in 5 years. Well, I took a look at that for you as well. Here is month number 60. So that now you're making these payments, you're doing it for 5 years. Month number 60. Now, when you make that payment of $2,328.56, you're still at 83% of interest that's being paid first, right? So let that sink in. 83% of your mortgage payment is first paying down the interest that you owe the bank, and $404.35 is actually affecting the principal. So only 17%. And this is already 5 years in. In fact, most mortgages, right? Especially if you've gotten mortgage within the last 2.5 to 3 years, most of those mortgages with interest rates at 6 and 6.5 and 7 and 7.5, they have a cross period of about 15 to 17 years. That means if you stay in that loan, by the time 17 years later, 15 years later, that's when more of your payment will cross over, and it'll start to impact your principal, and less will start to impact your interest. So that's 15, 17 years of your life, 15, 17 years of positive cash flow going to somebody else, right? And not actually benefiting you paying down the mortgage. So what would it look like if we go ahead and refinance, right? Because as I mentioned, interest rates are starting to drop. And let's say now we can get a refinance, and instead of having an interest rate of 7%, we're going to have an interest rate now of 6%. Well, let's fast forward. In January, we got the home, we got it for 350. So we fast forwarding. Let's say this is the very end of the year here. So it's going to be December, right? November, December. this is more or less what the balance is going to be at that moment, right? It's going to be 346,500. So you would go, the banks are enticing you, come on in and get a refinance. We're going to drop your rate to 6%. You're actually going to be able to save money. We're going to find out how much you're going to save, but let's look at what that's going to look like. So the entry in 2026, obviously we know the interest rates are going to continue to go down, but in this example, we're using a 6%. So at a 6% with the new loan amount, because we're already into the year, we're looking at a payment of $2,077.44. So what does that mean? Well, if we compare the two, we have a difference of $251.12, right? Now you're looking at it on paper, you're like, fantastic, you're saving $251. Over the year, you're going to save $313.44. But now, what is the true cost for you to do that refinance? Well, typically, the reason why you see this here is because there are things that are associated when you get that refinance, and you have to pay those things up front. One of the things that you have to pay up front is the closing cost. And typically, closing costs are going to run you somewhere between 2, maybe 2.5%. I did it on the lower end, but if you are charged to do the refinance for that 6% interest rate at 346,500, 2%, that's about $7,000 that you will be charged upfront just to get into the new lower interest rate. So let's look at if it costs you $7,000 in upfront closing costs, but you're saving $3,013 here on a yearly basis. That means it's going to take you about 2 years and maybe 4 months to replenish or regain, right, to earn back the $7,000 that you paid up front just to get the lower interest rate. Now, that's just one of the upfront costs that you're going to be paying to get that lower interest rate and drop your payments 251. So hopefully you're starting to see, okay, is this really worth the bang for my buck, right? I'm saving 3,000, but it's costing me 7,000 to do it. I don't think so. Now, here's the problem moving forward, right? If we look at the new payment structure, we look at the first month at 346,500. That is the new payment. So you're probably asking, well, how much of my payment now is actually impacting and going toward the actual interest? Well, you're still at 83%. $1,732.50 is 83% of the total payment. And again, we're not even including the taxes and insurance. And only 17% is actually impacting the principal. Now let's look at it in month number 60, right? Now we are into a new loan. And what we're doing here is we're going 5 years into the future. We're going to see how much that's going to improve in 5 years. In 5 years, you're still over 75%. You're actually at 77% of your mortgage payment is actually going toward interest, and only 23% is actually impacting the principal. So you can see there. So you're paying upfront costs. You're paying that cost for over 2 years. And then even if you fast forward going down another 3 years to get to the 60-year mark or 60-month mark, you're still paying 77% going toward the principal. And not to mention, you're most likely started the 30-year cycle all over again, right? So, and that's how the banks trap you. That's how they trap your cash flow. That's how they keep it working for them instead of you putting it to work for you. So I wanted to show you here so that you bring alertness to you, I bring awareness to you that don't get caught in this trap. Simply because the interest rates are starting to go down, that does not mean that it is an ideal time for you to go ahead and refinance your loan, especially if you're already into a loan that's been in force now for maybe 5, 6, 7 years, and you've already covered a lot of ground. Refinancing may not be the best idea for you. So if you're looking for an alternative way to do this, that's what this channel is all about. We talk about the rapid payoff method here, where we leverage lines of credit to be able to more quickly and efficiently help you pay off your loan. And if you're interested or if you need help doing that, you will find that my calendar in the descriptions below. Go ahead and click on there. Let's set up a call and see how I might be able to help you out. So until the next video, take care and God bless.